Hello everyone, I am Hemant Kanawala, Head of Equity at Kotak Life Insurance. I welcome you to November 2022 edition of Market Outlook by Kotak Life Insurance. As we are coming to the close of 2022, it's a good time to reflect what happened during the year and what it has in store for the next year. Inflation was the main area of focus of all the policymakers in 2022. There was high inflation building up throughout 2021 due to excessive stimulation given by various governments, and it was increased by Russia-Ukraine war at the start of the year. India has managed this situation well by not giving overstimulation during the COVID. The central bankers got into the action and they started increasing rates to cool off the inflation. Indian RBI increased the rates by 190 basis points, while US Fed has increased the rates by 375 basis points during the year. Other central bankers have taken similar action. The good news is that this has started showing results and inflation has started coming down. In India, we expect inflation to normalize within 4 to 6% band in FY24, and this will give room RBI to again start cutting the rates. This is further helped by softness in the global commodity prices, which was the main area of worry at the start of the year. As globally, investors are getting worried about growth going forward, India seems to be in a good spot in the current environment. And there are two reasons for it in the near term. One is India is having a strong consumption demand, and we are also having good investment cycle. The reason for strong consumption demand are, number one is reopening of the economy. This is creating a lot of demand in terms of travel, marriages, and other consumer demand. Also, as the economy is doing well, the job prospect seems to be better. The last year it was Indian IT sector, and now even domestically the job prospects are improving, which is giving a lot of confidence for the consumers to go and spend. And lastly, the real estate sector is showing a good recovery after almost a span of 10 years. So it started with government giving stimulus in the COVID year era by various tax incentives, and now that demand seems to be going on. And as we know, real estate is always one of the main driver of economic growth globally. The other main driver of the Indian economy has been a pickup in the investment cycle. For the last 10 years, the investment cycle has been very benign because of a slowdown in the corporate spending. But going forward, this is changing because due to the following reasons. Number one is today, both the balance sheets of bank and corporates are in a very strong position, which gives banks to confidence to lend and corporates to borrow and do the capex. Corporates want to do capex because capacity utilization in the economy is running above average in most of the industries, and they are looking to now ramp up their capacities. Also, there is a strong growth in central government capital expenditure led by healthy tax collection. As you know, the GST collection was averaging around 1 lakh per month, 1 lakh crore per month before the COVID, is now averaging around 1.4 lakh crores per month. And that is giving government confidence to keep on spending. And lastly, the supply side reforms taken by the government in the last few years in terms of production-linked incentive schemes and tax rate deduction is helping and giving boost to the investment cycle. All this has resulted in increase in credit growth in the current context, which was below 10% some time back, is now moved to around 15 to 16% in the current context. So export is the only weak link currently in the economy. This is due to challenges seen in the global growth, but as the global growth normalizes, this should also pick up. So what we have discussed so far is some of the tactical reasons why Indian economy will do in the short term. But look at some of the structural drivers of the market also. Number one is profit as a percentage of GDP. So during the last decade, as the GDP continued to grow, because of various reasons, the profit as a percentage of GDP came down from 5% to around 2%. And which means that Indian corporates were not earning enough profits or margins for the same. During the COVID, now we have seen the improvement. In the last year, the profit to GDP has increased to 4% of GDP. We believe can go up further to 5 to 6% over the time, and which will be the driver for the profit growth to be better than the GDP growth. Second reason is that we have always been worried about higher oil prices because that puts a lot of pressure on our external balances. But what has happened is that over the time, services exports, mainly led by IT, has been able to almost match the oil imports done by the country. So both are averaging in the range of $150 billion per year currently. And as services exports continue to do well, this will compensate for the higher oil import bills. So today, as a country, we are able to afford around $90 per barrel of oil also. Third, in the past, for the capital flows, we were a lot more reliant on FII flows, and we were always worried if FIIs withdraw, what will happen. And we've seen at the time of GFC in 2008, when the FII withdrew, our markets corrected very sharply. But today, our reliance is much more on FDI rather than FII. Now, advantage of FDI is that they come with much more longer term perspective. They invest in India and create capacities, and that gives a boost to the economic growth in the long run. So this is another structural driver for the market. And lastly, as we discussed that we are seeing changes in the export market, but India's export market share is improving gradually because of the various incentives given by the government, and we believe that it can double over the next 10 years to around 4.5% of the world export market. So that are the four main drivers of the GDP and market in the longer run. So as everything looks nice, what are the risks to this outlook? Number one, as we discussed, central bankers have done aggressive monetary tightening to cool off the inflation. Now, as of now, we believe that it will not have a very prolonged effect on the economic growth. But if the inflation continues to remain high and central bankers continue to tighten, then global growth can slow down, and it will have its impact on Indian economy also in terms of exports growth slowing down and also domestic capex coming down. Second is the global geopolitical tension. We have seen that because of Russia-Ukraine war, commodity prices have gone up, which has increased inflation, and the central bankers had to tighten it. We also hear that there are tensions building on the China-Taiwan border. So these are the events we will need to monitor, because when the geopolitical tension will go up, commodity prices will also rise, and that will put pressure on the Indian economy also. As we know, India is one of the largest importers of all the commodities, and whenever commodity prices go up, it increases our trade deficit and puts pressure on our rupee also. Third, the valuation. Indian markets have been one of the best performing markets in 2022. In rupee terms, we are back to the old highs, while in dollar terms, we are 10% below the previous high. Whereas globally, the markets have corrected anywhere from 20 to 30% in the current year. Because of this, India is trading one standard deviation above its long-term average in rupee terms, and even compared to other emerging markets, we are at a significant premium in PE valuation. So investors are getting warmed up to India because of its long-term growth prospects, but the valuation is keeping them away. And as the world economy recovers, there is a possibility that India may underperform the other markets during that area. So because of this, we advise investors to buy on correction in Indian markets, because the valuations are not giving you comfort to make immediate money in the near term. Thank you for watching this video. Have a nice day.